From a distance, modern markets look like a Netflix home screen. Whatever you click starts playing instantly. Stocks trade every second. ETFs can be sold with one single tap. Bond funds publish fresh prices every day. And private credit, those reports show lines that look suspiciously smooth. Every modern investment product carries the same quiet promise. You can exit whenever you want. But financial liquidity is not like cash locked in a safe. It is not a pile of money sitting somewhere in the system. Liquidity is a relationship. It exists only if at the exact moment you decide to sell, someone else is willing and able to take the other side. And when that relationship weakens, markets do not just become volatile, they become uncertain, in a more dangerous way. Because the question suddenly changes. It is no longer, what is this worth? The real question becomes, who is still willing to hold this? And that question matters more than ever today, because the "I can always exit" story is no longer a small feature. It has quietly become the business model. By early 2026, exchange-traded funds held nearly $14 trillion in assets. Private credit exploded to $3.5 trillion. This is not background noise, my friends. This is the structure. And the structure comes with a weakness most investors rarely see. What happens the day everyone decides to sell? To see how this works in the real world, start with one of the easiest illusions to believe. The idea that something must be liquid simply because it trades all day. An ETF looks perfectly liquid. You can sell it in seconds. Your app shows a live price. The spread looks tight. The chart never sleeps. Everything about it feels frictionless. But an ETF is only the wrapper. The thing you trade is not exactly the thing you own. According to the US Securities and Exchange Commission, ordinary investors do not directly create or redeem ETF shares. That job belongs to a small group of large broker-dealers called authorized participants. They are the institutions that assemble the basket of underlying securities and deliver it to the ETF or take it back in large creation and redemption blocks. When markets are calm, the mechanism feels invisible. ETF prices and the value of the portfolio usually stay very close. Arbitrage quietly pulls them together. But that link is not permanent. It is conditional. Because the ETF can keep trading on screen while the bonds or loans inside it barely trade at all. This is especially true in bond ETFs. The Bank for International Settlements has noted that bond ETFs sit on top of a much less liquid market than equities. Corporate bonds simply do not trade as frequently. Studies have found that the spreads of the underlying bonds can be more than 10 times wider than the spreads of the ETF shares themselves. In other words, the wrapper can look far more liquid than the contents. Your exit button feels instant, but the assets underneath may be moving through a much narrower door. That door became visible in March 2020. During the COVID market shock, several bond ETFs began trading at large discounts to the value of their underlying portfolios. Within days, some swung to significant premiums. Tracking errors spiked far above normal levels. The ETFs did not malfunction. They behaved exactly as designed. What broke was the assumption that the liquidity of the wrapper and the liquidity of what sits inside it are always the same thing. You can think of modern markets as a pyramid of liquidity. At the top are the assets that trade constantly. Stocks, large ETFs, highly liquid futures. These markets move every second. Prices update continuously. But as you move deeper into the financial system, liquidity starts to thin. Corporate bonds trade far less frequently. Many bonds change hands only a few times a day. Some may not trade for days. Below that layer sits an even slower market: private credit. Loans held inside private funds, that may not trade at all. These assets can remain on balance sheets for months or even years without a real market transaction. And yet, many of these assets now sit inside investment vehicles that promise something very different. Daily pricing, and in some cases, regular investor withdrawals. This creates a strange structure: liquid promises built on top of illiquid assets. Most of the time, that structure works because investors do not all leave at once. But when stress appears in the system, the layers begin to interact. Pressure at the bottom of the pyramid slowly moves upward until it reaches the part of the system that everyone can see: the market price. If the wrapper can trade more easily than the assets inside it, a strange thing begins to happen during stress. The ETF stops behaving like a mirror of the market. Instead, it starts acting like a signal. In calm periods, ETF prices stay close to the value of the portfolio they hold. But when liquidity disappears in the underlying market, the ETF often keeps trading while the assets inside barely move. And at that moment, something subtle changes. The ETF is no longer reflecting prices, it is discovering them. This became visible during the market shock of March 2020. Corporate bond markets slowed dramatically. Many individual bonds stopped trading frequently. But bond ETFs continued trading throughout the day. And their prices began moving away from the calculated net asset value. Some traded at discounts, others briefly at premiums. At first glance, that looked like a malfunction. But several central bank researchers reached a different conclusion. The ETF price was not wrong. The ETF price was simply the only real price available. Because when individual bonds do not trade, their prices are often estimated using models or stale transactions. ETF shares, however, still trade continuously. So during stress, the ETF sometimes becomes the place where price discovery actually happens. In other words, the ETF market may reveal where the bonds would trade if those bonds were actually changing hands. That insight changed how regulators think about ETF stress events. The volatility was not necessarily a failure of the structure. It was a signal that liquidity in the underlying market had already started to disappear. And once that process begins, prices do not move smoothly. They jump. Because the question investors suddenly ask is no longer, what is the model price? It becomes something much more direct. What price would someone actually pay right now? Liquidity has a strange property. It feels permanent when markets are calm. But in reality, liquidity is extremely fragile. Because most liquidity in financial markets is not natural. It is provided by intermediaries, dealers, market makers, banks. These institutions stand between buyers and sellers. Their job is to absorb trades and keep markets moving. But they do not have unlimited balance sheets. When volatility rises, risk limits tighten. Dealers reduce the amount of inventory they are willing to hold. Market makers widen spreads. And suddenly, the market becomes thinner. Trades that would normally pass unnoticed start moving prices. Large orders move markets dramatically, and liquidity begins to disappear. Not slowly, but all at once. Because once participants begin to doubt the ability to exit, behavior changes. Investors stop buying, and everyone begins watching the same thing: the exit. If ETFs can keep trading, even when the assets inside them become illiquid, a natural question follows. When too many investors decide to leave at the same time. Financial markets are often described as deep and liquid. But in reality, most markets behave very differently during stress. Liquidity is not evenly distributed. It concentrates near the exit door, and the exit door is smaller than it looks. During normal conditions, investors enter and exit gradually. One seller appears, a buyer takes the other side. Prices adjust smoothly, but stress changes behavior. Instead of gradual selling, markets experience waves of selling, and waves behave differently. Because every seller is looking for the same thing: a buyer. In calm markets, buyers are everywhere. In stress, buyers step back. Dealer balance sheets shrink, risk limits tighten, market makers widen spreads. The result is not just falling prices, it is falling market depth. Orders that would normally move the market by a few basis points can suddenly move it by several percentage points. And once that begins, the exit door starts to narrow. Not because selling is impossible, but because selling becomes increasingly expensive. This dynamic appeared clearly during the Treasury market turmoil of March 2020. Even the US government bond market, the deepest market in the world, experienced sudden liquidity shortages. Bid-ask spreads widened, market depth collapsed, and central banks had to intervene to stabilize trading.
And to support the smooth functioning of the Treasury market, we announced today that we will purchase at least $500 billion of Treasury securities over the coming months.
The lesson from that episode was simple. Liquidity does not disappear slowly. It disappears all at once. Because when investors rush for the exit at the same time, the system does not fail mechanically. It fails socially. Too many sellers, not enough buyers, and a door that was never designed for everyone to leave at once. By now, the pattern should be visible. Modern markets are built on layers of liquidity. An ETF trades on top of bonds. Bond funds sit on top of corporate debt markets. Private credit funds hold loans that rarely trade at all. Each layer promises something simple to investors: access and an exit. Most of the time, that promise works because investors do not all leave at once. Some sell, others buy. Markets move, but they continue functioning. But liquidity has one uncomfortable property. It is abundant until it isn't. And when it disappears, it rarely disappears in one place. It disappears across structures. If bond markets freeze, bond ETFs feel the pressure. If funding markets tighten, dealers reduce balance sheet capacity. If credit markets slow, private funds delay redemptions or gate withdrawals. None of these events are individually catastrophic, but together they reveal something important. Liquidity in modern finance is not stored anywhere. It is borrowed from confidence. And confidence can change very quickly. In calm markets, investors believe the exit door is always open. In stressed markets, they begin to ask a different question. Not, can I sell? But, can everyone sell? Because financial structures are designed for normal flows, not for synchronized exits. And the moment investors collectively test that assumption, liquidity does not gradually fade. It disappears.